5 months ago, we laid out our major media power rankings. The list went Disney, then Fox, then Warner Bros. Discovery, and finally Paramount Global, in that order. Since then, I've got to say, that ranking list held up pretty well. Disney's been far and away the best performer, finally doing something for my charitable trust. The stock up nearly 33%, although down badly today after a brutal intraday reversal. Fox came in second, up more than 3%, while I was right to highlight Warner Brothers and Paramount as the laggers in the group. I did get the order wrong. Warner was a much worse performer, down more than 16%. Yeah, but maybe it's time for a shake-up in the media power rankings, because it's sure been a busy week in this industry. The proxy fight at Disney came to an end yesterday, with Disney fending off legendary activist investor Nelson Peltz's bid for 2 board seats. There's also a lot of activity with Paramount, which has been engaged in complex takeover talks for weeks now. Plus, we've gotten fourth quarter earnings for each of these at this point, and some of these stocks had very big moves, which is why this is a good moment to reassess. Why don't we start like this? Let's start with the returning champion, Disney, the clear outperformer. The problem with Disney is that its stock has roared in large part thanks to the proxy fight. The board of directors knew they had to get their act together, right, to fend off Peltz. But now they've succeeded, and it might be a problem. I know I wish he'd gotten those board seats because, well, he's very good at helping companies create value, even as that's regarded as a controversial ride post, despite his good work at Procter & Gamble. Disney's made some major commitments to cut costs to set up a succession plan for CEO Bob Iger. Will they stick to those commitments now that Peltz doesn't have a gun to their head? That's the question. It was certainly on my mind as I watched David Faber interview Bob Iger in the 9 a.m. hour of Squawk on the Street this morning, and then did my own interview with Nelson Peltz during the 10 a.m. hour. Despite my best efforts, Peltz did not give us a clear answer on whether he's sticking around in the stock after losing the proxy contest. But he did say that if Disney didn't follow through on his commitments, like the $7.5 billion in annual cost cuts, or making more entertaining movies, then he might come back with another proxy contest next year. Look, I consider that a good thing, because it'll keep management on their toes, as there are enough votes among these index funds that will most likely turn against management if they don't follow through. I think management will follow through, though. However, as I said in a special alert to CNBC Investing Club subscribers earlier today, even as we sold some Disney stock Monday because it had run so much, we wanted to trim even more this morning again when the stock was up nicely. But we couldn't because of our restrictions. Of course, it doesn't mean I'm restricted from telling you not to sell, so I told you to sell. As I wrote in the Bolden, I'm still positive on the stock, but a good bit less than I was 5 months ago when it was, of course, much lower. Next, how about this Fox, which I correctly pegged as the second best of the big 4 media stocks in November? Well, when Fox reported its latest quarter, the numbers were surprisingly resilient. Nobody expected a great-looking quarter because the company's up against some real difficult comparisons. They had the World Cup in the year-ago quarter. But their sales came in slightly better than expected, and their earnings were magnificent. A 22-cent earnings beat off a 12-cent basis. Outsized. I still see Fox as a good, solid choice, especially because the stock hasn't run too much and has a reasonable valuation. Plus, we're now in an election year where Fox News will likely make out like bandits. You know what's not a good, solid option, though? Sadly, Warner Bros. Discovery. I put this stock in 3rd place 5 months ago, purely out of respect, not 4th place, because of the long-term track record of CEO David Zaslav, and we care about long-term on this show. But it's getting harder to see how he's going to pull this rabbit out of a hat. Remember, all the old-line media companies are up against the same set of challenges here, but Warner needs to navigate these challenges with the worst balance sheet in the industry, by far, actually, and the possibility of some mega-cap competition for their NBA contracts. You know the mega-caps won sports. In short, it's a high-wire act. The company needs to consistently put up strong numbers to outrun its debt maturities and interest payments. Sadly, the most recent quarter did not have strong numbers, with Warner Brothers missing expectations pretty much across the board. Best I can say about this one is that Dune 2 seems like a major success. At this point, however, I can't go positive on the stock until the balance sheet gets much more clean, and you have to respect that. We do balance sheet analysis here, and the balance sheet here is just not good. Finally, let's talk about Paramount Global, which is also an enigma. On the one hand, it's not doing well operationally, and it's the second worst balance sheet in the industry, a close second, actually. On the other hand, Paramount's considered to be in play, meaning somebody might buy the whole shooting match. I think that's the only reason why this stock has held up so much better than Warner Brothers over the past 5 months. But, man, for a company that's supposed to be in play, Paramount shares act terribly. These takeover rumors pushed the stock up from $11 in early November to $17 in mid-December. Since then, it's given back almost all of those gains. Because even if there is a deal, we've realized it's going to be very messy and probably not too rewarding for shareholders, at least the common shareholders like you and I. In fact, to understand this point, you only need to look at what happened this week. Yesterday, the stock jumped 15% on news that the company was entering exclusive merger talks with Skydance, a production company controlled by David Ellison, son of billionaire Oracle founder Larry Ellison. Sounds real good, right? Made it sound like a done deal, even better. Overnight, multiple analysts raised the price targets, and one even updated the stock, but then this morning, David Faber broke the story that thanks to the dire state of Paramount's balance sheet, here we go again, the company might need to do an equity raise of up to $3 billion or else no deal. That, my friends, is bad. According to Faber's reporting, Ellison and his partners would likely buy a good amount of any equity raised, but it would still be dilutive to shareholders. The market didn't care for this news, and that's why the stock sunk 8.5% today, giving back most of yesterday's gains. Long story short, even if Paramount gets a takeover bid, it probably won't be a huge windfall for shareholders, as nobody's crazy enough to pay up for this thing right now. People don't like this linear TV. By the way, great work again by my Squawk on the Street colleague, Mr. Faber. Given all this, how have our media power rankings changed? Well, first, I do want to swap Fox for Disney at the top of the rankings, with Disney moving to second because it's already run so much and the Peltz proxy fight is over. Again, as I told CNBC Investing Club members. Long term, I still prefer the House of Mouse, but for the rest of 2024, I'm betting on Fox because it still has the election ahead of it. Then at the bottom of the rankings, I'm going to swap Paramount and Warner Bros. Discovery too. Paramount in third, Warner Bros. Got to go dead last. They're both in not great shape. But at least Paramount has takeover chatter. Warner Bros. Doesn't seem to have anything. Bottom line, for the rest of 2024, our new media power rankings go like this. Fox in first, Disney in fairly close second, and then Paramount way, way down in a distant third, only slightly better than worst of breed, Warner Brothers Discovery. Mad Money is back after the break.
When we return, master the markets one stock at a time. The lightning round is up next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.